Jeb's got the listings lined up in a row. Josh brings the numbers, making dreams grow. First-time buyers stepping through the door. Keys to your castle, they're what we're here for. Navigating through the home buyer's maze. Educated steps in a world full of haze. The podcast is rolling with wisdom to share, helping you settle in your new land. Navigating through the home buyer's maze. Educated steps in a world full of haze. The podcast is rolling with wisdom to share, helping you settle in your new lair. Jeb and Josh, they're paving the way. Dreams to reality, they make it day. From the first hello to the closing sign, your journey to home is looking divine. Down, the numbers make sense. Jeb shows the vision beyond the white fence. Teamwork like this is rare to find, helping you leave all your doubts behind. They talk about homes and talk about life, cutting through the stress and the buyer's strife. With every word they light up the spark, guiding you through when the road feels dark. Jeb and Josh, they're paving the way. Dreams to reality, they make it day. From the first hello to the closing sign, your journey to home is looking divine.
Happy Tuesday. Welcome to another week of the Educated Homebuyer Live, coming at you a day early because there's some scheduling conflicts and we didn't want to miss out. Wanted to provide you guys with some information on what's happening with mortgage rates, the housing market, so you guys can become educated homebuyers. Josh, happy Tuesday.
Happy Tuesday to you. I want to get ahead of this and I want to answer the first question. Fritz would like to know, when are you beginning? Fritz, we're beginning. We're beginning right now at 5 p.m. on a Tuesday.
On a Tuesday, baby. In fact, this is going to be on Tuesday for the next couple of weeks. And the reason it had to change is Josh was just along for the ride on this little voyage. My son has decided to play volleyball, and they play volleyball on Wednesday afternoons from 4 to 5 or 5 to 6, depending on which day it is or which week it is. So we are changing it for at least a couple of weeks until that passes. And then depending on what you guys like, maybe we stay, maybe we go back to Wednesday. It's all up to you. But if you're new to this, how this works every single week is we talk about the housing market, update you on what's happening in the economy, what's impacting everything. And we do that through some charts, some dialogue back and forth, and then we get into answering your questions. So if you're new here, you have questions about what's going on in the housing market, hell, we answer any questions. You could ask about Josh's shirt, his hat. Well, we're going to talk about it.
You can ask about my first loss of the fantasy football season and how well we're working through it. What we've been talking to the team about, how we're going to pick it up and do a little better this weekend. Get back on Wednesday.
He's had a bad week. It's he's been talking about this since Sunday. So it's impacting him. So tread lightly, because you could set Josh off on a tangent here, and we need him. We need him here. But the big news this week is jobs. Jobs report comes out on Friday, Mr. Josh.
Does it? Does it?
I think it does. And
we're going to find out tonight at midnight whether we're getting a jobs report on Friday or not.
That's very true. That's very true. And we could talk about that. And the title of the episode is Homebuilder Regrets Price Cuts as the Housing Market Stabilizes. So KB Homes came out this past week and basically mentioned that they believe they probably cut prices too much too soon as the housing market there has stabilized. And now they're having a little bit of regrets with regards to that. And if you want that full article, it is in the description of the video. So make sure you check it out. But Josh, shall we start with some charts here and dive into things to get this rolling? As we're doing that, make sure you put your questions in the chat and we will go from there. And if this is your new first time here, and you're listening to us on the podcast, it is right now, it's every Tuesday at 5 p.m. Pacific Standard Time, typically Wednesdays, but for Tuesdays for a couple of weeks going forward, if you have questions that want them answered, you can dive in there and drop them in. So big news this week, Josh, is no news. Inventory just moved sideways. And I was kind of looking, the line above the red line, which is, 2025 is 2019. Those lines look very similar.
That's the only one with that much
is.
flatness as 2025 is 2019.
And ironically, that is what would be the last normal, quote unquote, normal housing market would be 2019 prior to all the craziness. And this year looks very similar to that in many ways. But we have really kind of been in this flat sideways pattern for a little bit of, last couple of weeks. But if we do follow 2019, it looks like inventory is probably going to start declining here in a meaningful way in the next week or two as we head throughout the end of the year. Orange County, Huntington Beach, we always like to look at that because that's where we're located. Orange County, we saw inventory drop almost 2% down to 4,462 homes. Huntington Beach, just 0.76% down to 263 homes. Looks like Huntington could cross over, 2024 levels here in the next couple of weeks. If we continue this, my guess is probably more move sideways than anything else, but we'll continue to update you on that and keep you in the loop. This is from Calculated Risk. They take a look at active inventory in a lot of different markets, and I like this chart. The bold areas are the ones that are kind of outliers to some degree in there. Sometimes I highlight them, sometimes I circle them or put lines around them. Today I just said, you know what, you can focus on what you want to out of this chart. But what we like to do is compare it to year over year. Most of those are up. Active inventory is up in most markets out there. There's still a couple outliers that are not, Minneapolis being one of them. What is that? Louisiana is down year over year. But then when you compare it to 2019 is kind of the real kicker because, again, that was a more normal housing market. You've got most that are back above those levels. Not most, a lot. And then you got a lot that are still down significantly compared to those levels. And most of that are down are on the east.
It's all the Northeast. It's like I'm literally looking for one that's not the Northeast. Virginia is the furthest south I can even find, and that's pretty far north.
Yeah, exactly. So again, inventory is the tail that wags the dog, if you will. Single family listings, again, not going to get into great detail on these, slightly above where we were in 2024, which again is what we want to continue seeing throughout the end of, for as long as possible. At some point, probably going to continue to move downward, but we still like to stay above that 2024 level. Weekly pending sales, again, above last year, even though rates are probably a little bit more elevated than they were this time last year. You got a lot of people that just jumped off the fence they've been sitting on, Josh, the proverbial fence that everyone's been waiting on for rates to come down. We saw a lot of buyer demand come off that, and those people are now back in the market, which is probably why we saw that jump. Price reductions basically moving sideways here, very flat over the last couple of weeks, which again is expected as inventory comes off, a little bit buyer demand comes to the market. You don't need to do the negotiation or the price cut that you did a couple of weeks ago, just because some more buyers out there looking at homes. Spread, we don't talk about this as much as I don't know, should is the right way to put it, but we don't always put a chart in here. How's that? This week I decided to throw it in just because it's kind of a noticeable move down, Josh. I took the time to draw a trend line just straight across from January of this year across, and you can see, we kind of bounced along it up until probably end of July, early August. And you can even see it was kind of a trend line even for last year on that, but just kind of noticeable drop beneath it. Is that something to pay attention to or not? I don't know, but this is a true trend line.
Yeah, well, and I have this saved in a custom Fred chart, so you can look at it day to day. They use it. It doesn't change day to day. The 10-year yield does, but they use that Freddie Mac primary mortgage market survey, which only comes out once a week. But it was interesting. Some of the dip that we saw 2 or 3 weeks ago was largely due to the differences between coupons in mortgage-backed securities and the way they're sold. So I thought we might at risk giving some of that back, where it was just more market mechanics versus actual change in the underlying fundamentals for lenders. But I've got it pulled up over here, and it's showing exactly what you're showing. A nice little dip here recently. So I hadn't noticed, but that's good. It's very good. It would be nice to get back under 2%.
Well, why that's important, guys, is we could see interest rates move down without the 10-year changing, if you will. The 10-year can kind of move sideways. If we see that spread compress, that's going to allow mortgage rates to come down, which is what we want to see. Ideally, we want to see both, but if we got to take one over the other, great.
Look at it this way, Jeb. As recently as May, it was at 2.53, and now we're at 2.15. That's almost 0.3% better in interest without any move in the 10-year. Just what the market is offering borrowers. So good things. It's good.
Good stuff. We always like to take a look at different indexes. This is the FHFA home price index over the last 12 months, Josh?
Yeah. And all of these numbers, we got Case-Shiller, we got FHFA. And if you look, most parts of the country on a 12-month are up. There were a few months that have been slightly negative. And it's interesting. This comes from Bill McBride, really good local economist here, follows this stuff really, really well. And it's funny, his conclusion in terms of looking at this was, hey, we're likely to see a few more markets dip into negative year over year in the coming months. But what we've seen, and we'll look at it here in this chart, there's rates staying where they are or continuing to move lower. We'll put a floor under the market. That doesn't mean that we're shooting back up. But what this chart is showing us, that black line at the top is interest rates. So as interest rates went up, the other colored lines there, the purchase index, the red is the market index, purchase and refi, and the green is the refi index. So loan volume went way down as interest rates went way up. And now we're looking here as it trends down. You can see on the very bottom right, all three of those indexes are trending up. We've seen, Logan's hit on this all year, is that the year over year figures for the purchase index have been positive almost every week this year. Some of them double digits. So you're coming off a very low base. So it doesn't tell you that this is, hey, a hot market or an inflamed market, but you can see here how sensitive this is to interest rates and how important it will be to see what the next move is in interest rates. So Jeb's charts show you guys what is happening in the economy or in the real estate market. And what we like to show you here is in the economy, because the economy is going to dictate what happens with interest rates. And then that will filter back to the charts that Jeb shows you every week. So this is really noisy data. This is that JOLTS data. So you can see up, down, up, down, up, down. But that red trend line is telling us lower lows and lower highs in terms of job openings for more than a year now, year and a half. So we hit another, not absolute low, but another low here on this. So this guy likes to do it. This is why we like to look at moving averages. The darker line there is a 3-month moving average. It sort of smooths some of that noise out. And you can see here, this is a pretty consistent trend that there are less job openings, less employers looking to fill positions. And the reason why we always want to point out why this is important is if there is a massive demand for employees and a small supply or a limited supply, wages are going to go up, and you're looking at likely wage-based inflation. This is telling us job openings are going down, and we're not likely to see that. 3 different looks at this. This is the actual hiring rate. The hiring rate, you can see, is going down pretty considerably. It went sideways for a bit, but when we look at it, it's been trending down here recently. The quit rate is flat and also sort of ticking down here at a very low level. So people are not quitting their job because they don't feel super comfortable about going out and getting another one. Employers are not hiring. And then what we're seeing here is layoffs. The layoff rate, it's pretty much sideways, but slightly trending up here recently. So employers are holding on to employees, but not hiring new employees. And employees are holding on to their job and not cruising out and looking for a new one. Jeb, this one's the mystery to us and kind of the theme to my charts. I don't always realize the themes until I'm start putting them together. I know what data came out and what we want to look at. But when we look at this here, just a lot of mixed signals. So this is telling us the last day of the quarter here, we have an uptick here in the Atlanta Fed's estimate for Q3 GDP. Normally what we talk about is the green line starts out way above the blue chip consensus, and over the course of the quarter, they converge and they end up pretty close to each other at the end of the quarter. This is going to be interesting to see who was right, the blue chip consensus or the Atlanta Fed GDP now. It's a nowcast. There's not, I mean, all they're doing is they have data that's correlated to GDP and they track it through time. This shouldn't be, this isn't someone's opinion, whereas the blue line is.
Well, let's talk about why that's conflicting, right? So you got job openings at basically an all-time low, and then you have signals showing the economy is like running like not all-time strength, but pretty damn high. I mean, what second quarter was it? The second quarter, Josh, that we were negative on GDP?
It was a big positive in the first quarter as we front run tariffs and then gave it all back, averaged out to very minimal, like 1.5% growth. And now we're going to say we're at 4. 4 is pretty robust. Over the long haul, you'd like to have the economy growing at 4 to 6% every year. So 4 is pretty robust. I don't know anyone who looks around at the current economy and goes, yeah, this feels like a 4% GDP economy.
All right. Yeah. Anyway, just wanted to point that out.
So again, sort of keeping with conflicting data, inflation is really important. This is the Cleveland Fed's nowcast on inflation. So on the year over year, they're projecting next month that whether your preferred flavor is PCE or CPI, core or headline, they are all getting close to 3%. So when we look at that, that's about 1% above where we want it to be. And if we look at just the 90-day average, the last 3 months, they're all well, at least CPI is up in more in the 3.25 range, and PCE is a little bit high, a little bit below that. But now we look at Truflation. They measure this as a high correlation to CPI over the long haul, and they're telling us we're at 2%, down from 2.09 a week ago, 2.16 a month ago. This is noisy. You can look at this chart. It's noisy data. It does bounce around a lot, but it's telling us that in real time, we are close to 2%, but all of the lagging data that goes into CPI and PCE is telling us that inflation is much higher. So if you're a voting member of the Fed, you have far more data than we have, but you're starting to see the conflicting messages that you're getting when you're trying to decide, what do we do next? Do we need stimulus to prop up this economy? Or do we have a 4% GDP economy that we probably need to make sure it doesn't overheat? Definitely conflicting data. So what does the market decide in the face of this? We went from, I think, Jeb, last week we were at 92% chance of a quarter-point cut. Now we're at almost 97% at the next meeting, and went from like 72, 73 in December to 75%. So the market is pretty convinced that we're going to get 2 more cuts the rest of the year. You can almost guarantee we're getting at least 1, but markets think we're getting 2. I threw in Jeb's pretty charts here so we could look at all of the blue lines without boring you guys. We got multiple pennants across different time frames. They all seem to be pointing to breaking down. So the bigger perspective would tell us down, but you look at the bottom right there, it's a sideways move. And not, do you want to go through, Jeb, why we don't necessarily love the looks of that chart right there?
Not really. I mean, I don't hate it. You know, what I try to do, like in situations like this, like, you know, obviously there's no actual science to this sort of thing. It's kind of like, you know, interpretation.
It's counting cards, not a crystal ball.
Sure. And like, you know, I don't know. It would take me too long to explain my whole thought behind it, but I see an opportunity for this to go higher, and I also see an opportunity for it to go lower. So it's kind of in this sideways movement. But what I like to do in situations like this, where you see a move down kind of consolidates and a move back up, and then it starts to turn over, where in the charts have I seen that before, and what happened afterward, right? So you start looking back, and there are times where that happened and the trend continued downward. So I like to think that we're kind of headed downward in this, and we got jobs report out on Friday, which could support that move downward.
We hope to have a jobs report on Friday.
Well, exactly. So let's talk about why we might not have a jobs report.
Well, here, let's close this one out, because Jeb, I feel the same way you do. You can interpret this negatively, you can interpret this positively. So I turned it over to GPT. GPT can read charts. And so it came up with a 55% probability that we stay in this range. So what is that range? 6.25 to 6.45 on the 30-year conventional, 5.95 to 6.15 on the FHA. It sees a 30% probability of a breakout to the high side and a 15% probability of a breakout to the low side. And that's clear as mud, but that's pretty accurate. If you had asked me and said, hey, gun to the head, write these numbers down, that's about how I feel. So if you are thinking in terms of locking, that's a good one. So your 10-year, if you're looking at the 10-year, we hope 419 to 423 at the worst kind of holds as the ceiling, and 4 has been a very, very solid floor. So that probably gives you an idea on the ranges. But Jeb, something that could give us the range breakout would be a jobs report coming on Friday. Tomorrow we get ADP. That will not be impacted by a job shutdown. And some people are proposing or thinking that if the government is shut down and we're not getting jobs on Friday, that ADP will take a greater precedence tomorrow. What are your thoughts?
Sure. I mean, could it? Absolutely. ADP doesn't have the history of moving the market like the non-farm payroll numbers that we should get on Friday. I'm optimistic that these knuckleheads are going to get it resolved by 11:59 tonight, and we're not going to have to worry about not getting it on Friday. But with anything, Josh, interpretation comes into this. People start theorizing what direction, and that can create volatility in the market. So you want the actual numbers versus some Yahoo out there, putting their thoughts into to people's heads about the direction of the market. So I don't know. Your guess is as good as mine. I'm over here. I'm battling Zillow at the moment out of my left here.
What are you battling them on? Why are we
Zillow? So Zillow has a tendency. So just for people listening, now when you put a house on the market for lease, back in the old days, I have clients that do leases, and it would syndicate to Zillow. Well, now Zillow has become this platform where if you want it on Zillow, you have to register it as a rental on Zillow, kind of separately from, the normal syndication from the MLS. So I've got years of lease listings in here. Well, Zillow likes to just, for whatever reason, starting about a month ago, they like to make all of them active again. So I start getting emails from people that are sending me applications on listings that I have. And I'm like, what's going on? Well, I type in Zillow here, and I had like 4 properties that are active that are not active. So I'm like trying to scramble to turn those off so people don't start calling. And, the tenants are like, why is my house on the market? So anyway, that's what I'm dealing with. Anyhow, yeah, all good.
That sounds fun.
Worse. Could be worse.
Ask us tomorrow. We'll let you know if ADP moved the market. Matt Graham over at MBS Live says that has not happened in the past when we've missed a jobs report. I don't know how often that happens. The government doesn't shut down all that often, and it usually would hopefully not coincide. But it probably would be at the end of a quarter, right? When it would come down to it. But what he was saying is that's everyone's hypothesis. They have not seen it move the market a bunch in the past. But we will absolutely take a look at it tomorrow, and we will not talk to you about it because Jeb's going to be at volleyball, and I will not be here.
You shouldn't be. You should not be here tomorrow for any reason at that rate. That's why we're doing this tonight, guys. So if you're just jumping in now, you're catching this live. We're a day ahead. In fact, Josh's wife texted me a moment ago and said, it's Tuesday, not Wednesday. And yes, we realize that. We are a day early, guys. Scheduling conflict for tomorrow. We didn't want to just drop you guys entirely and not have any update this week. So we came in a day early to drop some knowledge, answer your questions. So if you have questions, make sure you put them in the chat so that we can get them answered. So Josh, what do we have after this?
In terms of charts? No, well, we just got, and we kind of went through the ranges. GPT pulled these together because I feed it the Mortgage News Daily info. 6 3/8 for very well qualified borrowers, 780 credit score and above, 25% down. FHA and VA, it's got it here in the low 6s. Most of our clients are still down in the 5s, especially if they're having high end credit scores. There's our pretty map, Jeb. I didn't realize that we had added Oklahoma, and we have a couple Oklahomans in the audience who have reached out recently. So that was fortuitous. It was good timing.
Good stuff. So the red states are states where Josh is licensed. Blue states are states where the part of the team is licensed. Either way, we can help you. So make sure you reach out. You can use that link in the description of the video and get in touch with us. Or we've got a fancy new thing here, Josh.
Where is it? I want to see it.
Scan that QR code at the top.
See if
StreamYard
should we give a special prize to the first person to scan the QR code? I don't know.
How do we know? How do we
Honor
know?
honor system. You got to tell us you were the first one to get there.
Yeah, there you go. But you got to be, I mean, it's got to be more than just being there. But yeah. Anyhow, I see some familiar names in the chat who joining us on a Tuesday instead of a Wednesday. In fact, Leonardo reached out today, I believe, from the podcast. So thanks for being here, Leonardo. Hopefully, I don't know if Josh scheduled some time to speak with Josh or not, or if we were just answering a question. I don't remember. I remember
if
the
you
name.
remember let's kind of go through it because it's instructive for you guys. He's like, hey, these terms suck. I'm getting a VA loan. I'm not getting very good terms, but he's buying new construction. So he sent over the LE, and it was about exactly what I would expect. We've told the story of my friend who bought FHA last year, and the builder said they were giving him $30,000. When we run the numbers, it was actually about $18,000. If I remember correctly from Leonardo's numbers yesterday, builder's giving him $15,000. But the loan is about $4,000 more expensive than it otherwise should be. So if we just net that out, basically can say that they're getting $11,000 from the builder. Why builders like to play these games and inflate the gift that they're giving to you, I don't know, but it was still better than anyone else is going to do for him.
Good stuff. Josh, there was a question here. Marcus, one of our regular viewers, asked, why doesn't Mortgage News Daily post FHA adjustable rates?
Because the volume of those done is about this big. And for the most part, the benefit is not significant. And to get it, you end up paying points. We talk till we're blue in the face here on the show why we think that 0 points is the better route to go for the vast majority of people. To see a benefit on that arm, conventional or fixed, you're not really going to be looking at that in terms of 0 point. 0 point loan, 30-year fixed versus a 5-year or 7-year arm, Fannie Freddie, FHA, are going to look really similar. At one point, with paying 1 point, then the arms get much, much more attractive. So most people don't want to pay the points, especially FHA and VA buyers who are cash constrained. So just a very, very limited market. So not much interest in providing data that would cloud the message that Mortgage News Daily is putting out.
All right. Good stuff there. A couple people that were confused that it's not Wednesday. It is not. It is Tuesday. We got some clients in here too. Good to see you. Helped them buy a house in Compton earlier this year. What else do we got? What else do we got?
I don't know how helpful this is going to be for everyone, but Platinum Black says, is it a good idea to buy a house if your company just announced the largest private equity buyout in history and hasn't said if they're going to replace stock compensation with anything? So basically, working for a private company, if you've read the Wall Street Journal, you would know who it is, literally the biggest private equity buyout ever. So the company goes from public to private, and part of his compensation was stock options. And we have a lot of listeners in here that work in the tech industry where stock options are very common. So again, I don't know how many people are going to have their businesses taken private where this may change, but what I would compare it to earlier in the year, had a couple of buyers who were in government adjacent industries, and they were concerned about DOGE and different cuts and tariffs and whatnot. Most of them all gave it 2 or 3 months to see what happened and went ahead with it. But definitely always a good idea to be looking to the future and try and get clear on what that's going to look like for you, because it's definitely a different business structure than what you're operating under now.
Yeah, Kingston Technology did that here in Orange County, maybe 15, 12, 13, 14 years ago, something like that. They went from public, bought it back private. And I don't know what happened to stock options in that. They were very good to their employees though, through different things. But great move on their part, because now it's worth, however many $1 billion. And so it was a good move, especially if you were, the owners of it, if you will. But yeah, hard to say. I would imagine there would be some sort of compensation. I just don't know what that would look like, how they would do it. Let's see what we got here. Josh, not a lot of questions. So now's a good time if you have questions to drop it in. We did have this one. Josh, from
the one I was going to pull up. I like that question.
When considering new builds, is it better, in your opinion, to go with a builder that is cutting the price of their homes or one that is offering large incentives? So, Josh, we talk about this all the time. Rarely are we seeing builders cutting prices, right? We're often offering a lot of incentives. But KB Homes, as we mentioned at the beginning of the show, is one of those builders in Florida that was cutting prices, offering incentives, doing a bunch of things to unload property just because the market was kind of saturated with inventory and things weren't moving. And now they look back a little bit and say, I think we regret that a little bit because now the market's stabilized and things are starting to kind of move back up again. But what are your thoughts on it?
Was it Lennar or who was it about a month ago came out and basically said, we prefer to manage sales prices versus concessions. Very personal decision. I understand why some of these cuts, we have a listener who's looking here in the Inland Empire and they had just you got to realize it's all smoke and mirrors and it's not necessarily in your best interest. It is to push the right buttons to get you to move a unit for them. In his instance, he could do 3% down, 5% down. It's 800 plus credit score. He's got all the plenty of money. You can go either direction. And they came back and said, here's an FHA. We'll do FHA for you at 4.99%. That's real good, right? That is really good. But you look at that, he's going to pay more for the home. FHA has an upfront mortgage insurance premium, so we're going to owe more on the home. And to what end? I mean, what happens if 2 years from now rates are 4.5%? You had a benefit for like 18 months that wasn't really a benefit. It was truly a cost to the builder. The builder didn't screw you. The builder had to pay those thousands of dollars in points to buy that rate down for you. But if you can afford it, I would always rather have a lower price for the home. But what are your thoughts, Mr. Jeb?
Yeah, I'm right there with you. I think the same thing. I think you want the lower price home. The problem with that is most people live in the payment and not the price, right? So the price is obviously going to be a lot more attractive in rate buy downs and incentives and that sort of thing versus the price being a little bit lower. But as rates move down, hopefully you're in a position to refinance. You still got some equity in there, comp support, the value, all that good stuff. Over time, it should work out better in that situation. It might not feel like that at the moment, especially if rates stay higher for longer. But that's the direction that I would go. Mr. Lewis, what else do we have here? Just still checking Zillow over here, make sure they're not doing anything crazy because this is, just trying to make sure we're good. Anyhow, let's move along.
This is the fun part. Marcus has another good question here. For the deals that are closing, are buyers coming in with high down payments or lower down payments with buying down the rate? I was looking for it here because ICE tracks this data. Not ICE, the people that get themselves in trouble with raids. ICE, the technology company that tracks this stuff. And I just saw the chart. I was trying to pull it up quickly. But over the last several years, we have seen down payments continue to increase. We've seen credit scores continue to increase. We've seen median incomes continue to increase. And we've seen median debt to incomes ratios increased. So it's sort of all of those things. Let's kind of combine all the things that we were talking about. You asked a question about ARMs. We just talked about builders buying these things down, getting a loan, taking an FHA because it has a lower rate and paying a bunch of points to buy the rate down just to get in. I certainly understand why in certain instances that can be the only path. So I'm not 100% against it, but if we have other options, I would prefer to pursue other options.
No, good stuff. Good stuff. All right. Now's a good time to put questions in if you have them. We started the show by talking about us being here a day early, guys. We were here a day early because of scheduling conflicts. Going to be here for next couple of weeks, at least on a Tuesday. If you guys like this day better, maybe we continue it. If not, maybe we move back. You guys are kind of in the driver's seat for that one, so let us know. In the meantime, while there's not a lot of questions in here, now's a good time to ask what you guys want to hear about on the podcast. We got a lot of new listeners on the podcast, a lot of people reaching out, first time reaching out, and we appreciate that. A lot of positive comments. In fact, we had somebody ask last week, what could they do for us to help us, Josh? And at the time, I didn't really have anything in mind. And I thought, what could a viewer who finds value in our episode do for us other than like and subscribe and all the basic stuff that you would do? A really good thing that a lot of people, because it takes a little bit more time to do it, is write a review. If you'll write a review on Apple or Spotify, wherever you listen to podcasts, that actually helps. It helps out a lot on the algorithm. The more 5-star reviews we have on it, the more value, is seen in the show, the more it pushes it out, that sort of thing. Kind of like what YouTube used to be to some degree. So, if you're doing that, you find value, that's a good way to help us out. So All right. Let's see. We got Pablo. Is this Pablo, my old painter? Pablo, Josh?
I'm certain not. That
I'm
Pablo has
sure.
got a 40 somewhere and is
I'm
parked
not
on
sure that
a
guy's still alive, if I'm
yeah,
honest.
his liver gave out long ago. That man had
Wow.
the yellowest eyes I've ever seen.
He definitely did. Pablo, I have my mortgage with United Wholesale Mortgage, and I'm considering refinancing rather than calling daily to check rates. Is there a reliable way for me to get them or get notified? Josh, is there?
If you don't want to call someone every day, two things. So you can get on our rate watch list, and we can reach out to you when the opportunity arrives. And the first part to that is probably the most important. It's him having a conversation and running through and figuring out a strike rate. What is the rate that you would be in the market at? So that's the only way that we can know where that rate watch needs to hit. But if you want to watch it yourself, Mortgage News Daily is my preferred. It is the most accurate. It's not an advertising table. They're not trying to get you to put your information in so they can sell you as a lead to 42 different lenders who can tell you varying degrees of lies. They are just there tracking what's going on in the market so you can have an idea. So again, remember, at least for the conventional loans, that you have less equity, lower credit scores, the terms aren't going to be quite as good, but you can absolutely track day-to-day movement in the markets with that.
And if you didn't or weren't able to scan that QR code, it's jebsmith.net/rate watch. We'll get you all one word. We'll get you in touch on the rate watch and can reach out if something like that, get that strike rate handled. And when rates move, we can be in touch. So, Mr. Lewis, 35 minutes in, I want to ask a favor. If any of you are not already, make sure you hit the thumbs up and, subscribe to the channel if you're finding any value whatsoever. Every Monday, we put an episode out on the podcast, which is a deep dive into something with the housing market, whether it's rates, whether it's the economy, whether it's, prices and buyers and all that good stuff. So make sure you check that out on the Educated Homebuyer podcast channel. And then on my channel, it's kind of a free for all. I don't know what I'm going to talk about until I talk about it. So our Josh and I's conversation is a lot more in depth, and a lot of value can be gained just because you have two different opinions, kind of just going back and forth and talking through things.
So Jeb, if they don't have a question, I'm going to bring up something here. I didn't throw this data in the charts, but this was interesting to me. So for Fannie Mae, by vintage, for loans made in 2004 or earlier, we're talking 21 years ago. So 30-year loans with 9 years or less left on them. That is 1% of their portfolio, but 1.35% of them are seriously delinquent, and that's up 1.33% over the previous month. I ask how you've been in a home and made payments for 21 years and have 9 years or less left on it that you are getting yourself in trouble, and I don't know. But for loans made from 2005 through 2008, remember, those were probably the riskiest loans made, that part of their portfolio, 1.93% are seriously delinquent. That's up from 1.9. So for recent loans originated from 2009 to 2025, that's 98% of their portfolio. 0.49 are seriously delinquent.
Oh,
So
wow.
when you look at the chart makes it look like it's 1% and it's kind of trending up. The only uptick is really in these really old loans, which
Prior to
it's sort of
2000.
shocking. Like I would think those would be the safest, the best, they're the oldest, they've built up the most equity, they've had the longest time to appreciate. But we're really not seeing any signs of delinquency in single family. And multifamily is a different story because they're very different loans.
Yeah, and I was going through the Orange County data, today? Distress sales are basically non-existent. I mean, I think there were 8 total out of however many transactions, or 8 total foreclosures and short sales combined in Orange County, which is 3.3 million people here. I mean, it's a really low number. I got a question here again from Mandamo. When relocating to another state, is it easier to go new build versus a resale home? Do you have any experiences of previous relocation buyers who can share what they chose, how smoothly it went? Josh, the first part of the question is more relevant. So what are your thoughts?
I don't think anything goes more smoothly with new construction, primarily because it's a long time frame. and there's just more issues, things that can go sideways, go wrong. Not that they don't close, they don't end up in a good place. It's just that contract, that 130-page contract, you have far less rights and protections than you have in a normal contract. That longer time frame. I wish I had this chart in front of me, Jeb. United Wholesale on their weekly sales call last Wednesday, they went through and showed a chart of loans, how the longer they take to close, the less likely they are to close. And that's with anything. The longer something takes to happen, the less likely it is to occur. So from that perspective, if we have a 9-month escrow or a 7-month escrow versus a 30-day or a 45, so I like the certainty of the shorter terms, but there are absolutely benefits to new construction. You probably have more experience with that, at least in the recent market.
Well, let's talk about the context that the house is already done, right? And you don't have to wait on the building process, right? It's not a spec home. It's built. It's ready to go. Is that an easier transition for somebody to move into than an existing home? I would say, I mean, yes and no. I mean, to some degree, I think the answer could be yes, but it really is. Yeah, and vacant properties are a lot easier to move into and deal with than the transition of somebody moving out and having to deal with all of that, because maybe if they're buying something else, if they're delayed on their purchase, then there's so many moving parts there, whereas new construction, oftentimes you don't have to deal with that. But I wouldn't pigeonhole myself into new construction because of what the conversation is here. For me, it would be finding the right house in the right area at a price that I'm comfortable with, regardless of whether it's new construction or existing construction, and letting that be the deciding factor versus making the decision off of anxiety of, whether or not it's going to be smooth or not. I mean, the reality is things can come up in either way.
And I would say, I understand that from economic purposes, there's reasons why people look at new construction, but realize that at the same price point, you're looking at different things. Most new construction, and I could be talking out of my ass on this, but in my experience of what I see, most new construction comes across with some form of HOA, even if it's small. So that's an increase at the cost. Generally higher taxes, because most municipalities have pushed that onto the developers that put it in form of taxes to pay for schools. They're generally closer together. So is it nice? Is it new? Is it fantastic to walk in and I'm the first person who sat on this toilet, first person who's cooked on this range? Qualitative differences between those things.
You don't know what those contractors have been doing on those toilets.
I don't. They could have done very bad things.
You think you're the first one to poop on that toilet? You're not.
I was hoping I would have one first in my house.
Nope. Already been done. In fact, somebody probably set their bare ass on that thing in the factory before they ever put it in the box. Just
you think there's a guy who just sits at the end of the assembly line?
Yeah, he's just like, you know what?
First.
Yeah. You know how many toilets I've set on first? He tells his friends. See, you guys thought you were coming to an Educated Homebuyer podcast or live episode, when in fact, this is just Josh and I's normal conversations that we have. Right. Let's see here. Let's take a little survey. Wednesday. How many people here right now have never been here before? Have never caught a live before? Give us a 1 in the chat. If this is your first live ever, maybe this is your first time ever hearing of Josh and I, give us a 1. Otherwise, give us a 2. 1 is new. 2 is you've heard us before. You've been on a live before. Let's see how many people actually follow directions and can do this.
They heard there were some awesome guys on Wednesday night, and they're like, who are these randos on Tuesday?
Well, that's going to be my next question is if you are a regular viewer, you liking Tuesdays, you liking Wednesdays better, like middle of the week, hump day, get you over the hump. With Tuesday's a weird day just because a lot of data comes out on Wednesdays, like kind of midweek, so it's hard to give you all the goods, on time with doing it on a Tuesday. A lot of 2s in here, a lot of 2s. So no 1s, Josh,
because I believe we've selected been here, done this. We didn't get a lot of new people finding us this time.
You have frozen like I don't know how many times in the last like 5 minutes. I probably have on your side too, but Young has a question. Says, as a W-2 full-time tech contractor, would I have a hard time getting a mortgage? I have worked here for 3 months now.
Yes, because I say yes. It would be rare that your documentation wouldn't in one way or another betray that you are a contractor and not a full-time employee. But if it showed 40 hours week after week, full-time job, and nothing says contractor, it says what your position is on the pay stub, there is a chance that it could find its way through. But if you need a verification or anything in the documentation, a verification of employment, or if anything in the documentation says it, probably going to get detected that it's not a full-time position.
All right, good stuff. Alfredo says, what do you think about homes built 1900? Before 1900, I'm thinking, or around 1900, what to look for. Here's the thing. I have zero experience in selling or viewing 1900 homes that were built around 1900.
We don't have many in California.
No,
You got some
well,
20s, 30s, 40s, but not a lot of 1900s.
That's a long time. I mean, here's what I would think of is like, if that house is still standing today, that thing's going to stand forever. I mean, for the most part. But what would I focus on? I would focus on plumbing. I would focus on electrical. Things that, because a lot of code changes. I mean, essentially everything has changed since 1900, but the things that are important in why they changed, because of fires, because of different things over time, leaking, all that stuff is the major systems of the house, right? So I would focus on the foundation, right? What's the foundation look like on that property? Because there's no chance it's a slab, right? It's built on some sort of raised foundation. What's it look like underneath the house? Plumbing, electrical, heating, air conditioning, roof. Like those are the main things that are going to cost you most money. But I would think probably my focus out of anything would be the foundation, just because it is so old, depending on where that house is located. If the ground shifts, that sort of thing, it's and it's very costly to fix that sort of thing. So again, that's from somebody that has zero experience selling those homes. So take that with a grain of salt.
In our flipping days, Jeb, we definitely tore lots of homes apart. And I can say the 30s, 40s homes, the few that we did, the systems needed to be replaced. The plumbing needed to be updated to modern standards. The electric needed to, but the actual framing and the construction was generally very, very good.
Yeah. So my family has a house back in North Carolina. It was built in like the 1700s. And it was built without nails. Like it was like, I forget I'm drawing a blank on the.
So mortise and tenon?
No, it was, what the hell was it? It'll come to me in a minute. But anyhow, like, they withstand a bunch of hurricanes, and over time trees fell on it, and it had to just gradually be rebuilt from the original time frame. But I mean, the wood and all of that stuff, I mean, it's still the original. A lot of it's still the original wood of, from back 200 years ago. Just, I mean, it's solid. And yeah, well done. But, not to say that it couldn't be done like that today. It's just, homes are built a lot quicker these days. Not as much care goes into them, if you will. Young followed up, Josh, if it gets detected, will I be disqualified or have to accommodate more? Example, higher down payment, interest rate, etc.
More likely to be disqualified because it's just, there's not any continuing income there to confirm that you have. So it's not like they're going to just say, well, make a bigger down payment or take a higher interest rate. There are no doc loans for 20, 25, 30% down. They are rare and egregiously expensive. So most people don't want to do them. So from that perspective, I think you would like it. So more likely to be disqualified versus take worse terms.
There you go. Tom turned on the HEPA filter just in case you were talking out your ass, if you were serious about that. See, he did not want to catch any of that. Which right.
Tom's thinking of buying a new construction. We might be out testing his new toilets for him.
Fantastic. We already tested them. Let him know that. They're already tested, Tom. Tested.
They work. They work great.
They were great. Unless they're in California, they're low flow. So you not as great. Other parts of the country probably don't have to deal with that. So Platinum Black and Marty McFly both mentioned electrical when talking about older homes. So seems to be, and obviously lead pipes, that sort of thing, plumbing. We discussed that. So those are the things that you should probably focus on if you're considering something of that age. But no more questions at the moment. As we were having this conversation, we should have recorded this and then set it as a live to go live at the normal time. But then I thought we wouldn't have any questions. So that was the problem with the show. You can't do a live without being somewhat live.
Without being live.
Yeah. So anyhow, that's just my thought. I don't know why I talked about that now, but I did. Okay. Let's see. Any questions? People, let us know. Anything you want to get off your chest today, Josh? What's happening in the mind of Josh? People want to know.
So for those of you who know, we've been a little overburdened here recently. What would you make me go away for?
Oh, I didn't know. I was checking something there.
These guys over here playing games, making our faces disappear.
No, I was. There's a new button on the screen, and I thought, can I maximize you versus not having me on here? But anyway,
we have, Jeb, a new team member starting on October 15th. So hopefully, I don't lose my mind between now and then. That's going to give us additional bandwidth to help more of you guys. So that's the helpful, positive part of it. The downside is his name is Jed. So we're going to have Jeb and Jed, and no one is going to know who they're talking to or whether they should ask them about mortgages or real estate. So that's the downside.
That Jim, I get called Jev, all different sides. So I just essentially answer to anything. So if he's anything like me, he probably just says, yeah, like he just goes with it. Just, yes. Like I'm whoever you want me to be.
I got called Jeff this morning. For some reason, Josh turns into Jeff and Jason if it turns into anything else. So Jeff and Jason. I got a Jeff this morning at 7 a.m.
Starbucks likes to just call you different things. I think they do it just to mess with people. Like, oh, your name's Jeb, and then you like. I have the tendency, Josh, when somebody says, "What's your name?" Jeb, Jeb. I spell it out because it's easy. All confusion dissipates, right? I mean, like we've just eliminated every issue with spelling my name because I just gave it to you. People still screw that up somehow. It's amazing what comes back. And I think those people just did that just to just for fun. I like it, but anyway. Josh, the tracks are off the train.
The Tuesday crew fell apart on us. They got no questions, so we have to wrap early since we've run through the extent of what we've got. I was trying to think if I had any interesting stories, things that might be enlightening or helpful for those of you in the market. But mainly, I'm just tired this week.
All right, guys. Until next Tuesday. Adios.